Welcome to the Galileo May monthly update. It's election month coming up. We're recording before the election. The world is still grappling with lots of conflicts, and both political and economic, and inflation is still a kind of a scary story around the world. So there is a lot going on. And we've done quite a bit in the last few sessions around what we think about markets, what's going on at the time, and what you should or shouldn't be worried about. And we thought it was a good time to kind of just stop and remind people how we approach investments. What's the philosophy behind what we're doing, the structure and the kind of massive integrity that goes into our investment process. So I'm very glad that you are with us, Jonathan Tennyson. Thanks so much, because Jonathan and I run the Galileo House Views, with the unit trust and exchange traded fund selection that we do. So it's our job to kind of filter out all the research that we get everywhere and compile those house views, and then take them to our team and whittle them down to the end the end recommendations that you get. So Jonathan, I appreciate the time. And perhaps you want to kick off and just kind of give us a view of how this works.
Yeah, sure. Thanks for having me on. It's good to be here. And I think it is important because we talk about this stuff a lot with new clients, and then often not again. So I think it's important to remind our clients how we think about investing. And what contributes towards our thinking around how we develop our investment philosophy, and how that filters through to fund selection and the process. So there are a few pieces of sort of key research or studies that we subscribe to, and these are studies that have been done repeatedly over time and consistently produce similar results. So we're confident in the data that comes through them. And the first is one done by Brinson, Hood, and Biebauer, and that's around what drives the performance of investments, what contributes towards the performance of investments. And I think the thing that a lot of people agonize over, and what people are really interested in talking about around BRISE, is security selection and market timing. Where's the stock market at? Is it a good time to buy or sell, or send money out of the country, or bring money back? And I think it's interesting stuff, and I think it's important to understand where markets are at. But I think often our focus is misplaced. And this study shows that those two things, security selection and market timing, only make up 6% of what drives performance over time. 4% to security selection and 2% to market timing. The bulk of what drives performance is your asset allocation. So the other 94% is what contributes to whether money moves up or down over time. So that's what is your percentage allocation to bonds, cash, shares, and property. And getting that right is far more important than agonizing over the underlying securities. And obviously, there's nuances to that. You have to make sure that you're not overly concentrated in specific stocks. But if you're broadly diversified, then that should help you to achieve your goals pretty well without focusing too much on the small things.
And maybe just to jump in, Jonathan, for a second there. So when we talk about security selection, we just want to explain that for a second. So that's choosing the right share or the right property or the right bond. You can't say the right cash. Cash is cash. But security selection is where a lot of stockbrokers and a chunk of fund managers will promote their skill set, that they are capable of choosing the right share. And I mean, it sounds obvious, but it also means that they're telling you that they're capable of avoiding the wrong share. And Brinson, Hood, and Biebauer will tell us that over long periods of time, that moves your portfolio of assets up or down by 4%. In other words, we shouldn't pay too much attention to something that only moves your money up or down by 4%. And I think it's a key point in this whole thing is market timing. We understand. We're always talking about the rand. Where's the rand going? We always get asked, what's the currency or the interest rate or the stock market going to do? And most of the time, I hope we're honest enough to say we don't have a clue. And what we don't say always is we shouldn't care that much, all of us, because it's 2% of the reason why your money is going to go up or down. But I think it's an important point. Those two together, for every 100 rand that your money's moving up or down, it's accounting for 6 out of 100. It's just not a big number.
Yeah, exactly. And you're right. I think a lot of the stockbrokers and active asset managers will tell you that they can identify opportunities and they can buy and sell at the right times and at the best prices. And not only do we know that this doesn't contribute a lot to the end result, we also know that most of them get it wrong, consistently over time. If you track them versus the index, so there's studies that have been done. One particular one through the S&P Dow Jones. They track the index versus the active counterparts, and the number that's fairly consistent across the globe is that only about 15% of active managers consistently outperform the index over meaningful time horizons. So we have to be very careful around which active managers we are prepared to commit money to, and knowing all of this, we are always going to expose quite a significant portion of investor money to passive solutions, because we don't have the risk of underperforming the market that way. Firstly, we will get the market return, and secondly, it drives down costs significantly, which puts more of the return in the investors' pockets. But we do believe that there is a space for active management, and it does reduce risk if we allocate to managers that look very different to the index. So a lot of our homework, after taking all of this into account, is figuring out which ones to use, and we are very selective around that, and we've developed a framework that we use where we incorporate independent qualitative fund research and then apply it to our own matrix that we use to score those active funds based on a whole bunch of different metrics, and then that those active funds are then paired with the passive counterparts in each of the risk categories. So that's essentially how we develop our investment house view and some of the research around how we get there and what drives our thinking and the philosophy to apply to that framework.
And maybe just to kind of, we're doing a little bit of behind the scenes today, I guess. So that qualitative research that Jonathan's talking about is, we use a very big fund manager research business. They're endlessly reviewing what's available both in South Africa and globally, and then providing a rating of funds. And we will take that research. What's most interesting to us in that kind of research is not necessarily the end conclusion, which is this fund ranks in the top, in the top or in the middle or in the worst, because each fund manager research business will have its own way of doing things, and we need to match our clients to the right investment philosophy and implement that over the next 5, 10, and 30 years. But what we really want from these research houses is the up-to-date information on the staff of those fund managers, and then also the fact that they are maintaining their investment philosophy and implementing what they say on the box. And very often, that will be where we will get surprised sometimes, if we were doing this entirely on our own, is when a fund manager that we like or a team that we like moves. We might not hear that if we weren't using a research house. So we use that, and then there are every now and then some vigorous debates going on behind the scenes when we're deciding on whether a fund should remain in our philosophy, and I think key there that we don't drop a fund because it's had a 1 or 2 year period of underperformance. If we're paying a fund manager to be different to the index, then it follows that we would hope that it's always doing better than the index every single month of every single year, but there will be times when it won't. And if we're paying them to be different, it might be that they're not chasing the most expensive shares that are driving the index right to a peak before it falls over. And so they will underperform the index at that point. And actually, in a way, that's validation of the diversification. But I think it's a key point that it's not just the Galileo team that does the research. We pay and use really big research capability from outside our business as well, and then make sure that it ties in with our philosophy. And I think that we often get asked, how do you make these decisions? And the one point there that you're right, Jonathan, is we're selective, and I would like to say we're slow, and slow in a good way, because I think people are quick to change, and very often they drop a fund manager just before that fund manager's views unfold, and they deliver the returns that investors were paying for.
Yeah, absolutely. I mean, there are thousands of investment funds to choose from, and we can't do that research on our own. So we do partner with a professional business who does that for us, and they look at things like key man risk in the business, and are they managing money according to their philosophy? Because if they're not, then we have no control over that portfolio, because we're using them for that reason. We want them to look different to the index. And if the index is dominated by growth stocks, we will probably not choose an active manager that's sort of driven by that philosophy. So that is really important. But we've tested it and over the years, and like you say, we don't make changes quickly because the process is robust. So if we find that the top-ranked fund, actively managed fund, is now second in the next year, we're not going to switch out of it just because it's not the top on our framework. If there's nothing fundamentally wrong with the fund and it's still doing what it's supposed to do, then we'll keep an eye on it, and we'll keep an eye on the one that's now ranked number one over a year or two, and make changes slowly. Yeah.
I think I'm smiling as you're talking, Jonathan, because I think it's very hard sometimes to do nothing, and it takes a real skill to do nothing. And I think that's when you're making strong investment decisions. Sometimes not taking action is the best thing you can do, and that's certainly a lesson we learned from Warren Buffett over the decades. And I think you're right. The process is robust. We've been through the financial crisis in 2007, 2008, and clients came out well. We obviously more recently went through the COVID crash, and our clients did well through that. Sometimes means you don't lose a ton of money, and you lose some money, but you don't lose a ton. And so two very big events, over and above the all-time, kind of one of the big three big interest rate hiking periods in modern history in the US. We and our clients have survived all of that. Not always easily, and some people are grumpy when their performance is down for a year or two or three. But the point is often that there is no blow up. There's no permanent loss of capital. It's just a period where investments go down somewhat and then recover. And I think those of our clients who have been with us for a long time, they might not always remember how we created these portfolios and sometimes not even the why, but they live the experience of staying invested and sometimes doing nothing, and how that actually does work, incredibly well.
Mm-hmm. And I think we need to remind ourselves sometimes that doing nothing is also a decision. It's a decision to stay the course and to be committed to the plan and the strategy that we've agreed to. And there's another study actually that we use in our planning done by Delbar, which illustrates the difference between the return that an investor gets in a fund and the return that the fund actually achieves. And consistently, I think this has been done about 30 times over the years, and consistently it shows that investors earn about 20 to 25% less than what the fund earns because they make emotional decisions along the way based on fear or greed. And part of our jobs as financial planners is to coach our clients through some of those emotional times and help them to make better decisions. And that often means, most of the time, means remaining invested and staying the course.
Yeah.
So I think that gives our
sorry, Jonathan. It is the reason why if you're a Galileo client, there will somewhere in one of the first few conversations we have with you, especially if it's with me, we'll make you a promise. We promise to lose you money sometimes, and it's a very uncomfortable thing to tell someone, but that is the truth. And when you develop an investment strategy, you need to know that markets go down, and it's very much like the tide. The tide does go down. It doesn't go down and never come back. And I think making that promise to our clients that we will lose you money from time to time. The follow-on to that is if you stay the course and you stick to the plan, that the markets come back to you, the tide rises, and the only way you sink is if you change the strategy, and you instead of going out to sea, you drive your boat into the shore. I'm going to end the analogy there because it's going to get cheesy now, but I think that's the point is. The strategy is right. It does take into account markets falling. We don't know why they're going to fall. We don't know when they're going to fall. But we certainly know they're going to fall many times over a 30-year period. And then backing the strategy and the robust investment process is the best thing we can do.
Yeah. And if your asset allocation is aligned to your goals and your time frame, then you'll rise with the tide. Yeah, you just need to give it the time. I think that gives our clients a sort of refresher on how we think about things and how we develop our investment philosophy and fund framework. Warren, the other big thing that's happening that you mentioned at the beginning is we're heading towards elections. What, in your view, should we be looking at or thinking about or avoiding?
I think it sounds like a funny thing to say, but I would really encourage people to not follow the news for the next couple of weeks. Pretty much for the whole of May and maybe even June, if we're in a point where parties have to get together and form coalitions. I think it's going to be noisy, it's going to be messy. And lots of doomsday predictions from lots of vested interests, both in the media and from the political parties themselves. And the truth is, there is nothing that anybody can do about an election except vote. So if there is one action that you want to hear from us, we will tell you to please vote, because that's the way you can impose some kind of control over what goes on in your life. But beyond that, ignore the news. There's nothing you can do about these elections once you've made your vote and let them unfold. And investing according to a vote, according to an election is such a dangerous strategy, because you have to make so many predictions in order to kind of do this successfully. The first thing you've got to do is predict the election outcome. The second thing you've got to do is predict how other people, in this instance, other investors, are going to interpret that outcome, and then what that will do to stock markets. And you need to make then three very big, very difficult predictions if you want to be a successful investor by making investment decisions based on all those outcomes. So the answer is, don't change your investment strategy for an election result that you don't know how it's going to unfold. There is a very good chance that the Rand strengthens a lot in the next year, and it will have nothing to do with the election. Whether the election goes incredibly well, I don't know what well means, but whether it goes incredibly well or incredibly badly, if interest rates go down significantly in the US, over a 12 or 24 month period, that will be very good for all other currencies except the dollar, and most likely for emerging markets particularly. And that means the Rand will strengthen. So predicting that the Rand will go to 30 to the dollar because we get a bad election is a really fraught decision. So I think the answer to your short question was long, which is do nothing. Read nothing, listen to no podcasts, Focus on the things you can control, and for the rest, let us worry about this stuff. And we'll tell you if there is a time to worry. We don't think it is now, and not that we've got an ability to forecast the election. We just think these things tend to wash out over time, and you have a long period of time to make sensible investment decisions if you need to adjust after an election. You don't need to do it in a month before, and you certainly don't need to make big decisions in the month after the election. So for now, do nothing, and we'll keep you posted if there is something that you have to change.
Great. Yeah. I do track the news from time to time, and I think we're seeing a lot of the same sort of thing coming through that we saw before the last set of elections. And it was a lot of noise and nothing much materialized from all of that. And now we're seeing it again. So I agree. Avoid it as far as possible.
So I think on that note, let's wrap it up, Jonathan. To all our clients and everyone else that's watching, thank you very much for the support. Thank you very much for your patience and your trust in us. It's not always easy when you're watching, the world go wild around you, and then your Galileo advisors are telling you that everything's okay and you shouldn't do anything. But hopefully after this episode, you realize that a lot of work goes into doing nothing sometimes. And that's what we're doing now, and we will continue to do that in the next 20 years. So on that note, Jonathan Tennyson, thank you so much for joining us, and for everyone else, stay safe and please vote.